We are back. We're going to take a look at U.S. equity futures to kick things off here. And we see them lower, perhaps a little bit off the lows of the pre-market session, but still in the red. U.S. dollar is moving up. The U.S. 10-year is at a 14-month high. Lyle Stein, our featured guest, was just discussing that. We'll talk more about that throughout the show. Now, in Asia, Japan was closed for a holiday, but we do have Asian stock indices down 4 straight sessions. The Chinese yuan is at an all-time low, and the Chinese government is saying it will do what it can to support it. In Europe, we're seeing technology stocks lead the way down, specifically chip stocks, ASML, Infineon, ST Micro, all to the downside. There's a look at the FT100 in London, the CAC 40 in Paris, and the German DAX is off by about 0.5%. The TSX on Friday finished lower by 1.2%. All 11 of the subgroups were to the downside, led by healthcare and information technology. And leading us into our chat about oil coming up in just a second, we're going to take a look at West Texas Intermediate here, pushing solidly higher here by 2% to $78 a barrel on West Texas Intermediate to Brent crude. The global benchmark is around $81. This is a 5-month high. And let's get back to our featured guest here, Lyle Stein. We're going to talk about oil here a little bit more. So what is your take on oil sitting at 78 now?
Well, look at the price of oil over the last 6 months, say. It had been going down, and it got below $70, and everybody was focusing on a potential supply glut coming out of Russia, coming out of the Middle East. And what has happened really in the last week and a half is that where the political risk premium came out of the oil price as it fell to 70 and then below 70, now we're getting a political risk premium put back in, specifically relating to the Trump administration, or soon-to-be Trump administration, putting more sanctions on Russia and hopefully trying to take that oil off of the market. So you've seen the market take oil up 10% to today's $78 level.
Right. So even just a few weeks ago, the consensus seemed to be, oh, there's ample supply, and oil was in a tight range in 24, probably more of the same in 25, and that's shifting pretty quickly.
Yeah, and that's because the expectation was that the supply would come out of Russia and the Mideast. I think one of the surprises to the market hasn't really been the fact that demand has fallen off. The economies are not as robust as they were, but demand is still, well north of 100 million barrels, and it's not looking to fall anytime soon. But what had happened is that the expectation of supply coming out of Russia and the Mideast took people's traders' expectations down, and hence the price hit $70. The reality is oil, you need $60, $65 a barrel to make money, particularly in the U.S., particularly in the shale plays. And so at $70 oil, less than $70 oil, nobody was talking about the fact that markets will start shutting in. Now, who knows what's going to happen? But with these political pressures on the Mideast, that incremental source of supply isn't there.
So the incoming Trump administration has talked about drill, baby, drill, and more production out of the United States. But a lot of these producers in the U.S. have become quite disciplined, and they're not spending willy-nilly and drilling willy-nilly with shale like they used to. So even if the request is to produce more, would they want to produce more?
Well, that's the problem. The companies in the U.S. are trying to make money. And you've seen two things take place. Number one, all the good drilling targets have pretty much been drilled out. Number two, you've seen the smaller companies get absorbed by the Exxons of the world. And that has led to, again, that capital discipline that you refer to. So what's going to happen going forward is they won't drill, baby, drill unless they can, earn money, baby, earn money.
Right. So do you have sort of a forecasted range for oil this year?
$70 is probably a good floor price because that's coming close to that level of marginal production cost. It could go, I'm not saying it can't get to 65, 60 on a spike down. On the upside, really, that's a political thing. There's too many unknowns there. But the price of oil at $77 is very good for oil and gas investors. It's very good for producers. And I'm more focused on that than I am trying to predict the price of oil. All I know is that the cash flow that gets generated at this level is very good. And with a lower Canadian dollar, it's even better for our producers.
And do you tie oil's move into the rest of the commodity complex in that the CRB index, the closely followed commodity index that tracks, I believe it's 19 commodities, hard and soft, that had been moving up, and oil is sort of the last one to join the party. Do you find that interesting?
Yeah, well, oil is the big component of that CRB index. But you're seeing strength in copper. You know, people talk about the weakness around the global. Well, copper prices are $4.30 a pound. You can look at the price of gold. Gold is behaving in a way more consistent with stronger commodity prices than weaker commodity prices. You know, you can't call everyone. There's the agriculture elements, they dance to their own drummer. But the reality is those hard base metal commodity type investments or commodities are doing well.
Now, back to oil, how do you position your clients to be exposed to energy?
We have a real strong belief that natural gas is the better way to play it than dirty oil. We went into 2024 looking for a theme, and our theme that we wanted to talk about was this slower green transition, with natural gas being the intermediate solution. It's clean, it's available, and it's comparatively cheap to oil. So we see the gas story continue to play out. You look at Canada in particular, where we've got export capacity now available to us to export more gas. I mean, things are pretty good for the Canadian investor in energy in general, but particularly for Canadian investors in natural gas. So when you look at our portfolio, we have more gas stocks than we do actual oil. We've got a gas-levered portfolio, to put it that way.
We just saw natural gas prices up again this morning. Do you find it interesting that the demand from data centers for natural gas apparently, I think, rose 10% year over year? So does that add a sort of another pillar under the foundation of natural gas to keep prices, you know, because they were so low for so long?
Absolutely. You've read right into our theme. So we own the producers up there in Alberta and Saskatchewan and BC. We own the pipelines that move it to, in effect, the U.S. Northeast. AltaGas, just as an example, is the gas distribution utility, or owns Washington Gas Light, which is the distribution utility in Loudoun County, Virginia. 70% of all internet traffic lands in Loudoun County. There is not nearly enough backup capacity to run all the server farms, the AI now related server farms, and Dominion Energy, the electric company, can't meet the incremental demand. So gas is that interim solution. To us, that's about as clear as you can be.
All right.